The North American markets right now are incredibly overvalued. And make no mistake, that doesn't mean that every company in the market is overvalued. There are still some gems that we can invest in. One company like that is Cardinal Health. They're being valued so low right now that their free cash flow per share is 11%. And if you couple that with their expected annual growth rate of 5%, you have an opportunity where you can expect an average annual return of 16%. That means you can double your money every 5 years with this opportunity. So in this video, I'm gonna break down that opportunity for you in detail like you guys know I will. You're watching More Money, let's get it. What's up everyone? Thanks so much for tuning in. I'm Tay, and you're watching the #1 channel on YouTube for people that want to retire early. So let's jump right into it. The recent legal and regulatory challenges that the pharmaceuticals industry has gone through in the US has put a stain on the names of the publicly traded pharmaceutical distribution companies and has beat up their share prices. And to be honest, I actually think it's a bit overdone, which is why I think Cardinal Health can be a very decent value play for our portfolios. Now, don't get me wrong, this isn't something that's going to 10x over the next year. This is a strong company that's going to consistently churn out profits for you. Their free cash flow per share yield is 11% and they're growing at 5%. So you can expect an average annual return from this company of 16%. And with compounding, that means you can expect to double your money every 5 years. Now, what exactly is Cardinal Health? Let me give you a bit of an introduction before we dive into the details. Cardinal Health operates in the highly developed pharmaceuticals distribution business. And because this is such a developed and mature industry, Cardinal Health has a moat here through economies of scale, customer relationships, and specialization. This means that Cardinal Health has long-term staying power. They have very low debt and are returning all of that excess cash to you via dividends and share buybacks. That's what we want to hear, guys. So you can think of this company as a safer, higher yielding company at an approximate 16% annualized yield that's paid through dividends and share price appreciation. And since their valuation metrics are at an all-time low with their 1-year forward PE ratio being less than 10 times earnings, and their free cash flow multiple being at 9 times earnings, you have a little bit of safety here because the valuation isn't expected to decline much further than where it currently has. So in the industry, we call this downside protection. I'm always looking for that when I value companies. This is why I made 3 scenarios for Alibaba just to show you in that Alibaba valuation model that the downside risk isn't that bad. So guys, this is how we're gonna break this Cardinal Health opportunity down in this 3-part series. When I analyze companies, I use the Warren Buffett 4-question approach, which you can see right here. If you want a full analysis of what those 4 questions are that I like to ask, I made a video on that I'll link right here. In part 1 of this 3-part series, I'm gonna analyze the business model and investigate whether the business has favorable long-term characteristics. In part 2, I'm gonna gauge the competency and ability of management, and we'll look at the valuation of the company. Is it cheap enough to buy with a sufficient margin of safety? You guys probably already know that the answer is yes, but let's go through the details. In part 3, we're gonna do a full walkthrough of the free, fully downloadable model on Cardinal Health, which you can grab from the description below. And in that video, I'm gonna point out the 4 areas that you absolutely have to be aware of before making an investment in this company. And don't forget, guys, the best investment that you can make is by smashing that like button. It really helps YouTube know that this channel provides valuable content, and thus they'll continue to grow it. We're almost at 1,000 subscriber, guys, so thank you very much. And without wasting any more time, let's jump straight into the analysis. So is this a simple and easy to understand business model? I think so. 90% of the business is really just pharmaceuticals distribution. Let me break down the business for you right here. Cardinal Health is largely a healthcare products company. They provide medical products and pharmaceuticals through their supply chain to their customers. Think of it like a middleman. They sell their products to hospitals, healthcare systems, pharmacies, ambulatory surgery centers, clinical laboratories, physician offices, and directly to the customers in their homes. They have 2 segments, the pharmaceutical segment and the medical segment. And of course, as you guys already imagined, because it's a pharmaceuticals company, 90% of their revenues are made up of that first segment, the pharmaceutical segment. So let's dive right into that segment first. In their pharmaceutical segment, they distribute branded and generic pharmaceuticals and over-the-counter healthcare and consumer products to retailers, hospitals, and other healthcare providers. Now, what's really good about a company like Cardinal Health and what their value proposition is that they've streamlined the purchasing and distribution process, which allows them to pass on the lower costs to their customers. What this inevitably means is that they are a key cog in the medical supply chain. They also provide services to pharmaceutical manufacturers such as distribution, inventory management, and data reporting. They even go so far as operating pharmacies and repackaging generic pharmaceuticals and healthcare products. So that's the pharmaceutical segment. Now let's quickly jump into the medical segment. The medical segment makes up approximately 10% of their revenues. This segment manufactures and sources Cardinal Health branded general and specialty medical, surgical, and laboratory products and devices. Now the types of these products include things such as surgical gloves, needles, and syringes. There are a lot more products here, but I'll just leave you with that for now. Okay, so now you largely know what the business does. Let's assess the business model. Overall, guys, this is a very low margin business model. Think single digits. Their scale and distribution relationships are their major form of moat here, or competitive advantage if you haven't heard the word moat. I wouldn't say that it's an incredible competitive advantage, but it is one nonetheless. That being said, because they are in the pharmaceuticals and medical products distribution space, it's hard to see this business being disrupted. Additionally, guys, with an aging population, it's easy to see that the demand for more pharmaceuticals at a rate of 5% each year into the foreseeable future is absolutely realistic. Cardinal Health does seem to be the better of the three majors in this business segment, but I don't really think that says much, guys. And the reason for that is because, once again, this is a very low margin business, and on average, Cardinal Health's operating profit margins are running at 1.6% on average. That's razor thin. And if you really compare that to their major competitors, McKesson is running their operating profit margins at 1.5%. So not much difference here. When you're running operating margins that are that thin, you have to be careful because bad management can ruin the business very quickly. And to be honest, guys, it's not a make or break, because it's not that you can't say that you can have incredibly profitable and long-lasting businesses with thin margins. Think about Walmart or Costco. These are two that come in mind that have really thin margins, but they're absolutely phenomenal businesses if run well. Now, the one thing that I really wanted to investigate is, does this business have staying power? And to be honest, I believe that it really does. And the reason why I believe that is because I believe that the business is compelling, because if you have a scale in logistics, manufacturing, and relationships with vendors, you have the right to win in this space. And that's something that Cardinal Health does have. And that's what I mean when I say when you combine those three things, it really is a competitive advantage for Cardinal Health or their moat. I don't think that this is a business model that can be disrupted overnight, so that in itself is what makes Cardinal Health a major player in this necessary industry over the long term. Additionally, it's not like pharmaceuticals, medical supplies, and equipment are going away. It's not like a technology company can come and replace this business overnight. As society continues to age, having access to a company like Cardinal Health by healthcare providers will remain pivotal to maintaining access to necessary drugs and necessary medical products. In other words, healthcare providers are better by not having to worry about sourcing medical products when they have one company doing all of that work for them. They can focus on what really matters, which is taking care of us. Now, as you can imagine, I've been hinting on the fact that I'm looking at this business over the long term. I buy every company that I look to hold for the long term. Now, I'm going to dig more into whether or not this company has favorable long-term characteristics next. But first, I gotta remind you guys, if you received any value from this video thus far, please consider smashing that like button. It really helps YouTube know that this channel provides valuable content, and thus still share it with more viewers like you. Also, don't miss out on part 2 of this 3-part series, as we'll be doing an analysis of the management team and evaluation of the business to see if we're getting a sufficient margin of safety. Now, if you can't wait, you can get that valuation right now in the free to download model that I've linked in the description below. But guys, in order to not miss out on that video, please consider hitting that subscribe button and hitting that notification bell to be notified when I upload that video. Now guys, let's get right back into it. The second major question that I ask when analyzing a business is, does it have favorable long-term economics, and can the business stand the test of time? And like I said before, having access to medicine is the most important public need. I would say that it's so pivotal that it's only second to having access to shelter and clean drinking water. That being said, it's pretty obvious that having access to the right drugs at the right time, at the right price, is essential for society. This means that a business that allows for that to happen will be important for as long as society is around. And this is likely why the major players in this business have been around for a long time. Guys, Cardinal Health has been operational since 1979. Looking into the future, the pharmaceuticals business, which is 90% of Cardinal Health's revenue, doesn't look like it's going anywhere. So they do have favorable long-term economics in their major segment that will likely stand the test of time. Now, I don't don't want to just leave it there. You guys know I've dug deeper. There are 5 items that they are focusing on that are expected to keep them competitive and a compelling investment over time. COVID-19 created some challenges that Cardinal Health is attempting to address, which includes ensuring minimal disruptions to pharmaceutical supply in situations where short-term supply shutdowns can occur. They are focusing on key growing niches, which are in the specialty and connected care areas. There's also increased demand for at-home services, so this segment will continue to grow out. Also, the specialty, connected care, and at-home care segments are higher margin businesses. So this is really good for Cardinal Health with increasing that overall margin that the business does have. So having a focus on these areas is immensely important for the business over the long term. They're also focusing on proactively reducing costs, which will keep them competitive over the years to come. They're doing this with a 5-year, $500 million cost savings goal, which they are currently executing on. They're also shoring up the balance sheet to keep the company solvent and flexible to address all market conditions. This flexibility includes returning capital to shareholders and participating in opportunistic M&A transactions as they arise. They have been reducing their long-term debt by $1 billion each year in 2020, 2019, and 2018. And with the sale of a business which is expected to close in 2021, they are expected to pay down an additional $1.4 billion in long-term debt, which will largely take them to their leverage target. This means that there's going to be more capital to pay dividends, buy back shares, and participate in opportunistic M&A activities going forward. Their debt right now is only 15% of total assets, and of course that's expected to decline significantly once they do that $1.4 billion pay down as they've guided to. Now, it's not just that the business model is good. I want to think about ways that the business model can be improved. So that's a question that I always ask when analyzing an opportunity. I think the major opportunities for the business lie in the medical product segment. This is a higher margin business, and the demand for personal protective equipment, PPE, continues to outstrip supply right now. This is a huge opportunity to invest in proprietary manufacturing and logistics operations, which the company is doing. They have already told us in their conference calls that investing in the medical services segment is a key priority for the business. This, of course, guys, includes the previously mentioned increased demand for at-home and their services businesses. So when it comes to how the business can be improved, I believe that management is largely focusing on the same areas that I would want them to focus on. This is really great because with my investment into the company, I'm not providing management, so I'm grateful that the existing management is aligned with the way that I'm thinking. Now, where do I see weaknesses and threats with the business model? I think the biggest weakness and ongoing threat to the business is the ongoing litigation and legal fines that the business can potentially take. You guys might be wondering why the shares of this business are so cheap right now, considering that it's such a great business. And as often happens, it's usually something that's external that the business is currently struggling with. In this case, the industry valuations, which of course include Cardinal Health, are suppressed because of the ongoing uncertainty surrounding the legal risks with the business. This has resulted with the industry largely being forgotten by most investors. I do have some good news for you guys though. Cardinal Health has reached a settlement to resolve all pending and future opioid-related lawsuits by making a provision for $5.56 billion to be paid out over the next 18 years. Now, because they've given so much guidance, we can actually model that out. So you will see in my valuation model that I actually subtract this amount on a per share basis from their free cash flow per share valuation, because this is a very real cash item that is expected to be paid out over the next 18 years. In this situation, because Cardinal Health has that external legal liability, I believe that the free cash flow per share valuation model is the best way to value the company, and so that's what I'm using to largely rely on when I value the company. Now guys, I do understand that the market is scared that there could be large fines in the future. I get it. That's a risk of investing in this company. But this current potential liability, which is booked at the highest amount that they think that they could be assessed at, has a discounted value of $12.75 per share that we simply just deduct from the valuation, which I'll show you in part 2 of this series on Cardinal Health. So since they've booked a liability that they think is at the top end of what they actually believe that they're gonna get, I think the concern over the opioid lawsuits is largely overdone. When we factor in that liability into the valuation, we're still valuing this company at approximately $80 a share. And that's just with an 11 times free cash flow per share valuation multiple. So that's a really low multiple as well. So as time goes on and we get more clarity on the situation, the liability can be adjusted downwards, which would increase the total future cash flows that we investors would expect from this business. And once again, if we're valuing this thing at $80 a share with the potential liability baked in at its highest valuation, and we're slapping on a 35% margin of safety, so we're saying don't buy the company unless it's selling for $60 a share, which reflects an 11% free cash flow per share yield for software business that's growing at 5% annually, you see that we have a compelling investment opportunity here. So there you have it, guys. I'll see you in part 2 of this series.